Yeah, I need to talk to you today about the US dollar index and gold because I'm seeing some really eerie similarities between the action both now and right before the stock market crashed in the fall of 2008. Now, I'm not saying that the market's going to crash in the next couple of weeks or anything like that, but it's the action in these things that are trading in a real similar fashion. And let's look at the US dollar index first on this chart. And I've drawn these two lines connecting the recent highs on the dollar index with the lows. Well, not recent, it's going back to 2008 when the dollar index actually put in a bottom. And it's been going sideways since then in a very wide range. And at the same time, gold in gold stocks has been chugging higher since the spring of or the fall of 2008. Both put in bottoms then. The U.S. stock market, of course, put in a bottom in 2009, but the action in these led the action in the stock market. And but first, let's talk about the dollar index. The similarity is that the dollar index, this is in a position right now where it could easily start a run for a couple months and trade up to the top of this range here, which would take the US dollar index to about 85 from where it is now, about $80. Well, and if you want to trade that, there's an ETF, UUP, which tracks it and can make some money. Now, if you've been following the site real closely, several weeks ago, I recommended a trade where people short the euro by going along a short euro ETF. And now the dollar is in a position to go up. It trades opposite to the euro. So the trades are very closely linked. Now let's look at the dollar. Why do I think it can go up here? All right. These lines here, this is the upper and this is the lower 200-day Bollinger Bands. And what they measure is the long-term volatility in whatever it is you're tracking with them. Most people use a much shorter-term Bollinger Band to do like 3 to 5 day swing trades. I'm using the 200-day Bollinger Band to track long-term trends. And when the bands widen, as they did in 2009, that's a signal that a long-term trend change is about to occur. And this indicator here is plotting the width between the two bands. So you can see in 2009, the Bollinger Band width, the width between the two bands, reached a very, very extreme level, which was a signal that the uptrend for the dollar index, which started in 2008 as the stock market grew increasingly bearish, was at an end. What happened in 2008 was that everything sold off just about across the whole world. And even the things that were supposed to go up as safe havens, such as gold, sold off too. And gold stocks just got completely hammered. The only thing that went up were treasury bonds and the US dollar. And then the dollar continued higher until the stock market put in a major bottom in 2009. Well, this is what I want you to notice, and this is what's so critical right now, is that these 200-day Bollinger Bands are now tightening and getting very narrow. That means the volatility in them is shrinking, and it's shrinking at a point that only happens every couple years. And when it shrinks, it happens after a time of sideways action and consolidation, and then a large expansive move takes place afterwards. For example, in 2008 here, the Bollinger Bands narrowed as the US dollar index formed a base right here, a stage 1 base in fact, and notice these are long-term 150 and 200-day moving averages. The Bollinger Bands contracted, and then the dollar index broke through this stage 1 base. If you're familiar with my book, Strategic Stock Trading and Other Work, you'll know exactly what I'm talking about. And bam, it started a huge rally, which coincided with the stock market crash of the fall of 2008. And here you got the Bollinger Band thing contracting here. Well, the last time they narrowed was 2010, in the April springtime period, right before the flash crash took place and right before the Greek debt crisis really hit headline news in the United States. There's some volatility in the U.S. stock market, and the dollar index shot up into that. Well, what's going on right now, you got to pay attention to this. The 200-day Bollinger Bands are narrowing even more than they did in 2010 before that move. And they're in a position where they've gone, the U.S. dollar index has gone through those long-term moving averages, and it's pausing after breaking through that and breaking above the upper 200-day Bollinger Band. What this means is that over the next, let's say, 3 weeks, the dollar index must turn back down, or else there's going to be an expansive upward move in it that's going to cause a lot of volatility in the other financial markets. And you can see the the Bollinger Band width is at a very low level, lower than is seen, just as low as what was seen in 2008. And the dollar index is pausing right here. If it breaks out again, if it's going to do this, it'll probably happen in January, not tomorrow, not next week, but probably in January. It's going to start a rally up to there, a sharp, fast rally take place over a couple months. This is important because what it would probably mean is another pullback in gold. Now this line here is gold, right? This blue line. This is gold from 2002. This is basically the secular bull market in gold. Now, I'm not saying the secular bull market in gold would end. I don't believe that at all. I just think that a dollar move up here would last a couple months, but it would bring a correction in gold, which we've seen bunches of them over the past 10 years. We're in one now, in fact. Something similar to what we saw in the fall of 2008 here. Here's gold, boom, boom. And the interesting thing, too, about gold is it tends to lead the action in the dollar. If you notice in 2008, gold topped out well before the dollar broke out, well before the stock market crashed, too. Gold was leading the action in the stock market, leading the action in the dollar. Well, gold has already peaked out this year. It made another top, a lower top, I think it was August, September, and now it's broken through, you can't see it on this chart, I have plotted down, but it's broken through the 150 and 200-day moving averages, which has acted as support since 2008. It's trying to bounce back through them, and it appears to be failing right now. It's trying to form a base. It hasn't succeeded, and if it falls again through and makes a new low below what it was the other week, it's going to be in what I believe is a bigger correction down a couple hundred points, a 10 to 20% correction from here in the price of gold, which would coincide with a breakout in the U.S. dollar index. And here's the fundamental factors driving all this, of course, is the European debt crisis, which isn't over and probably won't come to an end for another 6 months. And as the euro continues to sink, money is flowing out of there into treasury bonds, into the U.S. dollar primarily, and also right now into U.S. stocks. The U.S. stock market is a whole different subject for a whole other video, and I do still believe we can still see the market continue to rally a little more this year, but at some point, if these trends continue of the European debt crisis continuing to unravel, and this picks up into a rally in the dollar and gold falling some and correcting, the U.S. stock market's going to take a hit too. But for now, it's in rally mode. Don't worry about that. We'll talk about that later. Right now, I just want you to focus on this U.S. dollar index and the ramifications of what that means for the gold market. Okay? It would mean if the dollar index succeeds in breaking out, doesn't fail now and go lower, gold is going to take another hit. much like it did in the fall of 2008. Now, here's why this is on my mind so vividly, okay? In 2008, I can remember the action month by month, week by week, sometimes day by day, what was going on, because I was heavily involved in it. In August of 2008, well, almost the whole year of 2008, I was bearish on the stock market. I was sending people articles about all the banking problems. It was just evident we're heading for some big trouble. And in fact, on the cover of Barron's in June or July, there was an article right on the cover about how Fannie Mae and Freddie Mac was going to go bankrupt. Okay, within months, it was clear to anyone who was just simply reading the news and using their brain and not just depending on what other people were telling them on the television, that a serious banking crisis was going to take place in the fall of 2008. And as a result of that, the Federal Reserve would have to print money and lower interest rates and just go bonkers. Well, of course, exactly that's what happened. Now, here's what happened to me, though. I did short the market. I made a lot of money, doing that. But I made one mistaken trade that year. I went long gold stocks in August of 2008 based upon the simple logic that, hey, the Fed is going to print money. That means gold's got to go up. That's inflation. Well, yeah, eventually that came to be true. But in 2008, gold collapsed. And because the hedge funds that are all invested in it, and they just liquidated everything and got in dollars and bonds. And gold stocks crashed. Well, what happened to me was in August 2008, I was watching gold stocks trade sideways, and they're falling and hitting a support level repeatedly, bottoming off of it. And I bought off one of these support levels thinking, well, it's inevitable that gold stocks will break out and gold will go up. It's just inevitable based on my fundamental reading of the situation, which was correct. Well, what happened was I bought these gold stocks and they surged for like a week, and then they turned around and fell out of the sky like a rock falling out of a balloon. And I got stopped out for about what I paid. I didn't lose any money. May have broke even. If I lost, it was barely anything. And I was short in the market too, so I eventually made money on the crash of the stock market. But gold just got crushed, and the gold stocks it was unbelievable how much they fell. Okay? Well, right now, the charts are very similar. Gold stocks are going sideways. They're trading weaker than the metal. They're trying to form a support level, and they're repeatedly, so far, succeeding in holding that support level, which, let me see what, below the video I'll put notes of what the support levels are for you to watch. But they're bottoming, succeeding in doing that so far. And the thing is, though, if this dollar index breaks out, in the next 4, 6 weeks, 3 weeks, whatever, those gold stocks are going to take a hit. Now, I don't think they're going to decline like they did in 2008. I mean, they fell. It was unbelievable. And one thing about the gold stocks now is they're not that highly valued. Most of the major gold stock companies like Newmont, Barrick, Goldcorp are trading between P's of 13 and 18. They're not that highly valued. And when they do have a high P/E ratio, such as in the case of Goldcorp, they've got such high earnings growth that they're not really highly valued at all. Goldcorp has a forward price to earnings growth ratio for the next 5 years of 0.5. Again, if you're familiar with my book, Strategic Stock Trading, you know that means it's a cheaply priced growth stock. On a fundamental basis, there's virtually no justifiable downside for gold stocks, especially when you look at the big macro picture. More money printing's coming. The central banks of Europe are printing money like mad. Today on CNBC, Bill Gross predicted that the Federal Reserve is going to do another round of quantitative easing in the fall of 2003. Yes, it's coming. But just like we knew in the summer 2008 it was coming, we can know it's coming now. We know the euro crisis is going to crack wide open. We know eventually that's going to hit the stock market. Logically, it means more inflation. But gold and gold stocks can still decline because of the damn hedge funds that are so invested in them, and they're not trading them, they're not investing in them as if they're a monetary instrument. They were buying gold stocks and gold and precious metals as a play on the world economy, as a play on China, as a play on emerging markets, as an inflation trade on macroeconomic growth, which right now is taking a side, is asleep. China's stock market is fallen month by month. The emerging markets are performing worse than the United States. It's a global slowdown, and I don't think that means squat for gold. Gold to me is a monetary instrument. It's money. And the Fed's printing more. The Central European banks are printing more. Every central bank of the world is virtually printing more of it. But the problem is these hedge fund guys, they don't think of it like that. They just think it's this trade along with everything else they trade together. And it's a risk on, risk off. And by God, if this U.S. dollar index breaks out in the next couple of weeks and the euro debt crisis breaks wide open, for them guys, it's going to be risk off, and we could easily sell a bout of selling in the gold market. We can see gold stocks suffer for several months. Probably not like they did in 2008, because there's no justifiable reason to sell something cheap down and beat it down even more. But we've seen many gold stock corrections that are nothing like that. But when you go through them and you live through them, they're vicious. 2005 right there, and 2004 right here. 2003 right here. Now remember all these things because actively trading them. So I just want you to be on the lookout for the action in this U.S. dollar index. And if it breaks through 83 in a week or two, you're going to have to be on guard for selling in the metals markets. And eventually this is going to result in turmoil in stock markets across the globe and in the U.S. stock market eventually. But right now, hey, it's Christmas time. You know, we're probably still going to see the Dow break 12,200 and have a nice little run for a couple weeks. But you've got to keep your eye on these larger trends that are just the background, but they run everything in the long run. And there's something really big boiling right now in the U.S. dollar index. And it's either going to peak out over the next 2 or 3 weeks and start dropping again, or else we're really heading for some big turmoil in the markets. Now, how would you trade this? Take advantage of it? Well, simple. Check out the ETF UUP. It's a bullish ETF designed to move twice the U.S. I think one times the U.S. dollar index. There's another one that trades twice the rate. So if you want to try to trade this, what you do is you just sit back for about a week, let it see if it consolidates, see if it succeeds in holding its recent gains. And then if it breaks out, you just buy this UUP ETF, and you are in a position to make some money while just about everything else over 6 months or whatever will be in big turmoil. So I want to alert you to this, and I'll be talking to you later on. We'll keep an eye on this together and watch how this unfolds.